Before we begin with this video, I just want to clarify that this is just for entertainment purposes and should not be used for any financial decisions, and this is not considered financial advice. Number 1. Betting on extreme long shots. What I mean by this is placing significant bets or investments on outcomes that have extremely low probabilities of success. This is a highly speculative and risky behavior where individuals hope to achieve substantial gains with minimal investment, often based on chance rather than any form of strategy. These include, but are not limited to, casino gambling. In a casino, games like roulette or certain slot machines offer very low odds of winning large sums of money. Betting a significant amount on a single number in roulette, for example, might pay off big if it hits, but the chances are very slim, and you know what they say, the house always wins. High-risk speculative trading. In the financial markets, making high-stakes bets on extremely volatile and unpredictable assets, such as certain penny stocks or options with distant expiration dates, can be considered betting on extreme long shots. The potential for significant losses is high, and success is often more a matter of luck than skill. Sports betting on highly unlikely outcomes. Placing large bets on the underdog in a sports match where the odds are overwhelmingly in favor of the opposing team is another example. While upsets do happen, they are extremely infrequent, and betting against odds with large sums of money without careful consideration is a risky move. Betting on extreme long shots is generally not a sound financial strategy. It's important to base financial decisions on thorough research, analysis, and a realistic understanding of the associated risks. Responsible investing involves diversification, risk management, and a long-term perspective rather than relying on improbable events for financial success. Number 2. Impulse shopping sprees. Impulse shopping refers to making unplanned and spontaneous purchases without careful consideration or thought. Impulse shopping sprees occur when individuals engage in a rapid succession of impulsive buying, often driven by emotions, marketing tactics, or external influences. Here's a more detailed explanation. Impulse shopping is frequently triggered by emotions such as excitement, stress, boredom, or sadness. Advertisers and marketers often capitalize on these emotions to encourage impulsive buying behavior. Engaging in an impulse shopping spree typically involves neglecting a budget. People who overspend or make purchases without assessing whether they can afford them. This lack of financial discipline can lead to financial strain and debt. Moreover, impulse shopping is driven by desire for immediate satisfaction. Individuals may buy items on a whim, seeking the pleasure of owning something new without considering the long-term consequences. During an impulse shopping spree, individuals may not assess the true value or necessity of the items they're purchasing. This can result in accumulating possessions that are unnecessary or quickly lose their appeal. After excitement of the shopping spree subsides, individuals may experience buyer's remorse. They may realize that the impulsive purchases were unnecessary or that they overspent, leading to feelings of regret and stress. Impulse shopping can divert funds from more meaningful financial goals such as savings for emergencies, investing, or paying off debt. While an impulse shopping spree may provide momentary satisfaction, it often comes at the expense of long-term financial stability. Failure to plan and budget can lead to ongoing financial challenges. To avoid falling into the trap of impulse shopping sprees, it's essential to cultivate mindful spending habits. This includes creating a budget, identifying needs versus wants, and taking the time to evaluate purchases before making them. Developing a more intentional and disciplined approach to spending can contribute to better financial health in the long run. Number 3. Burning cash. The most literal sense of losing $1 million involves literally setting fire to your money. While this may seem absurd, it's an extreme example of thoughtless and wasteful behavior. Burning cash is a symbolic representation of wasting money without any purpose or benefit. It implies a complete disregard for the value of money and a willingness to destroy a valuable resource for no productive reason. Unlike spending money on goods or services that may have some inherent value or utility, burning cash provides no tangible return. Of course, money has the potential to be invested, saved, or used for productive purposes that contribute to personal or financial well-being. Burning cash is a symbolic act of missing out on these great opportunities. Financial goals typically involve accumulating and preserving wealth, achieving financial stability, and planning for the future. Burning cash is antithetical to these goals and represent a reckless and counterproductive mindset. Burning cash can be seen as a manifestation of financial illiteracy or a lack of understanding of basic economic principles. It's a stark example of squandering resources without regard for their potential value. Number 4. Investing in unproven schemes. Investing in unproven schemes refers to allocations to projects, ventures, or financial opportunities that lack a credible track record, verifiable success stories, or a proven business model. Investing in unproven schemes often involves insufficient research and due diligence. Without a thorough understanding of the investment, its underlying assets, and the people behind it, investors are susceptible to making decisions based on incomplete information. Unscrupulous individuals may promote unproven schemes as lucrative investment opportunities to exploit unsuspecting investors. Without proper scrutiny, investors may fall victim to fraudulent schemes that promise unrealistic returns. Moreover, promoters of unproven schemes often present overly optimistic financial projections and potential returns to attract investors. However, these projections may be based on assumptions rather than empirical evidence, leading to disappointment and financial losses. Unproven schemes may lack transparency regarding their operations, financial health, or the use of investor funds. Investors should be cautious when information is vague or difficult to verify. Established investments often provide historical performance data that investors can analyze. Unproven schemes, being new or lacking a track record, do not offer this valuable information, making it challenging for investors to assess potential risks and rewards. Furthermore, the allure of quick profits in unproven schemes can lead to herding behavior, where investors follow the crowd without any independent analysis. This can contribute to market bubbles and increased vulnerability to financial losses. Unproven schemes may operate in less regulated environments, increasing the risk of fraudulent activities or unethical practices. Investors should be cautious when dealing with investments that operate in jurisdictions with lax regulatory oversight. Due to the speculative nature of unproven schemes, there is a significant risk that they may fail to meet investors' expectations. This can result in financial losses and erode confidence in the investment landscape. To avoid the pitfalls associated with investing in unproven schemes, it's crucial for investors to conduct thorough research, seek professional advice, and exercise caution before allocating funds to any investment opportunity. Number 5. Making large bets based on emotions. Emotions such as fear, greed, excitement, or panic can cloud judgment and lead to impulsive decision-making. Making extremely large bets based on just emotions may result in irrational choices that deviate from any strategy. Overconfidence can lead to excessively optimistic views about potential returns, while greed may drive the desire for quick profits. Investors who make large bets based on these emotions may ignore potential risks and overlook the importance of risk management. Fear can trigger panic selling during market downturns, causing investors to liquidate their positions at low prices. More than that, experiencing losses can evoke emotions of frustration and a desire to recover what has been lost quickly. This may lead to making large, huge risk bets in an attempt to recoup losses, which can exacerbate the overall risk profile of the investment portfolio. Imagine an investor who has a well-diverse portfolio of stocks. Due to a sudden and significant market downturn triggered by external factors, their portfolio experiences a huge decline. Seeing the losses on their investment portfolio, emotions take over, and their instinct is selling off a significant portion of the stocks. Instead of maintaining a rational long-term perspective, the decision is driven by the emotional need to avoid more losses in the short term. By succumbing to panic selling, the investor locks in the losses incurred during the market downturn. The decision to sell is based on a short-term emotions rather than a thoughtful analysis of the market's cyclical nature and historical recovery patterns. The impaired judgment results in missing out on potential future gains as the market eventually stabilizes and recovers. Emotional decision-making may cause investors to ignore the fundamental analysis of an investment, focusing solely on short-term fluctuations or speculative trends. Remember, these examples are intentionally exaggerated and foolish. Responsible financial behavior involves careful planning, research, and thoughtful decision-making. Always seek advice from financial professionals and avoid unnecessary risks.